Most traders believe they are prepared for volatile markets. They believe that if the market suddenly becomes active, they will simply follow their strategy and everything will work. But when volatility actually arrives, something very different happens. Prices move faster than expected. Candles become larger. Markets move up and down rapidly. And suddenly, traders feel pressure. Pressure to act quickly. Pressure to protect profits. Pressure to avoid losses. In extremely volatile markets, the biggest challenge is not technical analysis. The biggest challenge is psychology. In this video, I want to talk about the trader's mindset in extremely volatile markets. Because when markets become unstable, the difference between successful traders and struggling traders is not information, it is emotional control. If you stay with me until the end of this video, you will understand why volatility creates emotional pressure, how professional traders think differently during these conditions, and how you can train your mindset to stay calm when markets become chaotic. And if you want to develop the mindset required to trade consistently, consider subscribing to Bull Mindset. This channel is dedicated to helping traders build discipline, emotional control, and long-term thinking in financial markets. Now let us begin with an important truth. Volatility is a natural part of financial markets. Markets are not designed to move slowly all the time. Sometimes markets move quietly. Sometimes they move aggressively. Volatility increases when uncertainty increases. This uncertainty can come from many sources: economic news, interest rate decisions, geopolitical events, unexpected data releases, global crises. When uncertainty rises, investors adjust positions quickly. Large institutions move capital, liquidity changes, and markets begin moving faster. Now here is where psychology becomes extremely important. When markets move faster, the human brain interprets this as urgency. Urgency creates emotional pressure. The brain begins thinking, something important is happening and I must react immediately. But reacting quickly does not always mean reacting correctly. In fact, volatility often pushes traders to make impulsive decisions. And impulsive decisions are rarely disciplined decisions. This is why volatile markets reveal the true psychology of traders. In calm markets, many traders appear confident. But in volatile markets, emotions become visible. Fear increases, greed increases, frustration increases, and discipline is tested. Let us talk about fear first. When markets move aggressively, traders begin worrying about losses. Positions that looked comfortable suddenly feel risky. Small pullbacks feel dangerous. This fear can cause traders to close trades too early. They exit before their strategy actually signals an exit. The result is missed opportunity. Now let us talk about greed. Volatility also creates excitement. When prices move quickly, traders may see rapid profits. This can trigger greed. Greed pushes traders to increase position sizes. Greed pushes traders to chase price movements. Instead of following their strategy, they follow emotion. And when the market suddenly reverses, those emotional trades become painful losses. Now, let us talk about frustration. Volatile markets often include sudden reversals. Prices may spike in one direction and then quickly reverse. This can cause traders to feel confused. They may think the market is unpredictable. They may believe their strategy is failing. This frustration sometimes leads to revenge trading. Instead of following a plan, traders begin forcing trades. But here is something very important to understand. Professional traders do not expect volatile markets to behave smoothly. They expect chaos. They expect uncertainty. And because they expect it, they prepare their mindset in advance. Let us talk about how professional traders think during extreme volatility. First, they slow down. When markets move fast, beginners try to move faster. Professionals do the opposite. They pause. They analyze. They take a moment to observe the environment, because fast markets require calm thinking. Second, they focus on risk. During volatile conditions, price swings can become larger. Professional traders adjust their risk accordingly. They may reduce position size. They may widen stop levels. They may trade less frequently. These adjustments are not signs of weakness. They are signs of discipline. Third, they detach emotionally from individual trades. In volatile markets, individual trades become less predictable. Professional traders understand this. Instead of focusing on being right on every trade, they focus on following their process. Now let us talk about real trading examples. Imagine a trader during a highly volatile day. The market opens with a large gap. Prices move rapidly. Within the first hour, several strong price swings appear. A beginner trader might feel excitement. They may enter trades quickly. They may increase their position size because the moves look profitable. But the market reverses. Suddenly those trades become losses. Now frustration appears. The trader tries again. Another loss happens. Within a short time, the account suffers significant damage. Now imagine another trader in the same environment. This trader notices the volatility. Instead of increasing risk, they reduce their position size. They wait for clearer setups. They accept that not every movement needs to be traded. They focus on protecting capital. Over time, this trader survives the volatility. The difference between these two traders is not intelligence, it is mindset. Now let us talk about mental frameworks that help traders survive volatile markets. One important framework is acceptance. Volatility is not a problem, it is a condition of the market. When traders fight volatility emotionally, they become frustrated. When traders accept volatility, they adapt. Acceptance reduces emotional resistance. Another framework is patience. Volatile markets create many movements, but not all movements are opportunities. Professional traders wait for their setups. They are comfortable letting the market move without them. Because missing a trade is not dangerous, but forcing a trade can be. Another framework is probability thinking. Even the best trading strategy will experience losses. Volatility can increase the frequency of losses. Professional traders understand this. They evaluate performance over many trades, rather than judging themselves based on a single outcome. Now let us discuss a practical exercise that can help traders remain calm during volatile markets. Before entering a trade, pause for 10 seconds. Ask yourself 3 simple questions. Is this trade part of my strategy? Is my risk acceptable? And am I calm enough to execute this trade objectively? These questions create a moment of awareness. That awareness protects traders from emotional decisions. Another useful exercise is breathing control. During high volatility, traders may feel tension in their body. Their breathing becomes shallow. This physical reaction increases emotional stress. Slow breathing helps calm the nervous system. When the body relaxes, the mind becomes clearer. Now let us talk about the importance of long-term thinking. Volatile markets often create short-term excitement, but trading success is built over long periods. Professional traders think in months and years. They know that one day of volatility does not define their career. Because of this perspective, they remain calmer during short-term chaos. If this video is helping you understand how to manage your mindset during volatile markets, consider subscribing to Bull Mindset, because this channel focuses on the psychological skills that help traders survive difficult market environments. Now let us move toward the final idea: control. Traders cannot control volatility. They cannot control economic events. They cannot control market reactions. But traders can control their behavior. They can control their discipline. They can control their risk. And they can control their mindset. This is the difference between reactive traders and professional traders. Reactive traders try to predict every market movement. Professional traders focus on managing uncertainty. Let me leave you with a final thought. Extremely volatile markets are not dangerous because of price movement. They are dangerous because of emotional reactions. Fear can cause traders to exit too early. Greed can cause traders to risk too much. Frustration can cause traders to break their rules. But when traders learn to control these emotions, volatility becomes manageable. It even becomes an opportunity. Because while emotional traders panic, disciplined traders remain calm. They observe the market, they follow their plan, and they allow probability to work over time. If you want to build this level of psychological discipline, subscribe to Bull Mindset. Because mastering trading psychology is one of the most valuable skills you can develop in financial markets. Stay patient, stay disciplined, and remember that the strongest traders are not the fastest traders. They are the calmest thinkers during chaos. I will see you in the next video.